news from the BBC. Share prices in London and New York have fallen again today, with no end in sight to what the American President Herbert Hoover has called the Great Depression.
The summer of 1932 was one of the warmest on record in the US, but Wall Street wasn't exactly in a holiday mood. The Dow Jones Industrial Average, which had soared to a record high of 381.17 in September 1929, slumped to just 41.22 in July 32. It had lost almost 90% of its value in less than 3 years.
With me in the studio is a London stockbroker. Cedric Montague Smythe, what advice can you give to those of us with investments? Well, we obviously can't hear from Mr. Montague Smythe just at the moment.
Of course, the crash and subsequent bear market of 1929 to 1932 were truly exceptional, and it took many years for markets to recover. But for wise investors, it proved to be a huge learning experience and an even bigger opportunity.
Well, I don't know about our stockbroker friend here, but personally, viewers, I'm going to follow the advice of those jolly nice chaps from Sensible Investing TV and learn from these 6 key lessons from market history. Now remember, it's only 1932, so television graphics are still very basic, but let's see what we've got here. Oh yes, here we go. Be realistic.
Time and again throughout history, investors have come to expect unrealistic returns, from tulips of all things in the 1630s, to railway shares in the 1840s, to tech stocks in the 1990s. If it sounds too good to be true, it probably is.
And the next tip. Stay calm. In fact, why not do what I do in a crisis? Have a cup of tea.
We British are famed for our stiff upper lips, but market history proves we can panic with the best of them. There was the panic of 1825, of course, then further panics in 1837, 1847, 1866. We could go on. Sensible investors don't panic. Instead, they prepare in advance for the worst and stay calm during inevitable periods of market turbulence.
Oh, sorry, I was taking that keep calm thing just a little bit too seriously there. And the next tip. Forget timing. What's all that about?
Of course, we all know now we should have piled into equities in 1990 and bailed out in 99, got back in again in 2003, out in 07 and in again in 09. But in practice, working out when a bull or bear market is about to begin is all but impossible. You should invest instead for the long term. Forget timing the market, it's time in the market that counts.
Thank you. And the next lesson. Sorry? Oh! Keep it simple. Sorry. Even in a recession, you can't get the staff.
The investment industry loves complexity, but complex investment products are usually expensive and often produce poor returns. Sometimes, as the 2008 crash proved, they're downright dangerous, not just to personal wealth, but the entire economy. Best to keep things simple, and the simplest way to invest in equities is via index funds.
Now keep watching, because we're almost there. Okay, diversify. Because variety is the spice of life.
Yes, the oldest advice is often the best, and throughout market history, investors who've put all their eggs in one basket have been caught out time and time again. By contrast, those with a balanced portfolio of shares from different regions and economic sectors, as well as less volatile assets such as bonds or cash, have always been rewarded with positive returns over time.
And finally, my personal favourite.
Once you've decided on your attitude to risk and built a portfolio to match, do nothing except to rebalance your investments either once or a maximum of twice a year. That's right, while all about you are fretting over whether to buy or sell, just sit tight. Markets will always fluctuate in the short term. Best to set a long-term course and stick to it. Even if you had been unfortunate enough to invest, say, $1,000 in equities at the very height of the market in 1929, it wouldn't have been a total disaster. All right, your investment would have only been worth $170 when values bottomed out in 1932. But say you'd held on to your investment until 1959, and 30 years is a typical time horizon for an investor saving for a pension, it would have earned you a pretty reasonable annualised return of about 7.8%. Your original investment would have then been worth more than $9,500. In fact, whatever the period, markets have always rewarded those who learn from the lessons of history. Those who work out what risk they're willing to take, build a portfolio accordingly, and stay the course. And there's no reason to believe that for our generation it will be any different. And time for a quick check on the Dow Jones before we go. Last time I looked, it was up just a little bit on that low of 41.22 back in 1932, at somewhere around 15,000. Goodbye.